This is the Retirement Lifestyle Advocates Radio program. I'm your host, Dennis Tubbergen. Glad you're listening in today. Joining me in the second and third segments of today's program is Dr. Robert McHugh. Bob is a technical analyst, and we are going to get his take on what lies ahead based on his analysis for not only the U.S. economy, but also traditional retirement investments like stocks and bonds. These are investments that often you find in a 401k plan. Bob is going to share with us his take on what happens to these asset classes moving ahead. This is the last opportunity to get the June special report, which is titled the Mid-Year Market Outlook. You can get your copy of the special report that gives you my take as well as the take of four different experts on where stocks, bonds, gold, and the U.S. economy goes for the rest of the year. And when you go to requestyourreport.com and request this report, I'll also include for you some free information, including a copy of my best-selling revenue sourcing book, as well as a copy of the Little Black Book on Social Security Maximization. If you have not yet determined how you want to collect Social Security, if you've not yet looked at different ways to maximize the benefits that you'll get from Social Security, this book, I think, will serve as a valuable resource for you. All this information is available absolutely free, no future obligation. Just visit requestyourreport.com. I'll be glad to send you this entire box of information in the mail, again, at no cost to you and no future obligation to you. Well, here on the Retirement Lifestyle Advocates radio program, I spent a lot of time talking about retirement and the obstacles and hindrances that may stand between you and a comfortable, stress-free retirement, if that's something you aspire to. Now, with each passing day, it seems there are more signs that the notion of a comfortable, financially secure retirement is more of an elusive dream than an eventual reality for many Americans. Now, let me give you just one example. Many retirees depend heavily on Social Security benefits for some of their retirement income. Now, if you look at the average monthly benefit paid by Social Security, it now stands at just under $2,000 a month, $1,907 per month. Now, Social Security benefits do increase based on the U.S. government's estimate of inflation. But as anyone who is collecting Social Security will tell you, these cost of living adjustments fall woefully short when it comes to keeping pace with the real inflation rate. And that's because the official inflation rate is adjusted, if you will. I might use the term manipulated through substitution adjustments, adjustments to weightings, something called a hedonic adjustment. And to give you an example, without getting too far down in the weeds on this, the cost of living adjustment that Social Security recipients received in 2024 was 3.2%. Now, if you've been to the grocery store over the last year, if you've been to the local hardware store over the past year, you know firsthand that 3.2% doesn't begin to cover the increase in costs on the everyday items that we all have to buy. Now, the Motley Fool recently conducted a survey of American retirees. Now, there was a couple results in this survey that really were quite surprising to me. Again, these were people that were all retired that participated in this survey. Now, get this. 44% of survey respondents stated they are considering a return to the workforce since their retirement incomes are not keeping pace with inflation. 61% of survey respondents stated they are struggling financially day to day. 19% of those surveyed who were not retired in a separate survey made the statement that they're planning on working longer due to inflation and an economy that feels shaky. I had a conversation this past week with a local couple. They were planning on retiring at the end of this year, but now, because of inflation, they are going to work longer. And when I asked them what their plan was, they said they're going to keep working and making money, and they're going to wait and see. But the current trajectory of the economy makes them nervous. So if you're thinking about retiring right now or in the near future, inflation is enemy number one for those that have such aspirations. Higher prices have created significant financial pressures for many U.S. households, forcing them to pay more for basic necessities like food and housing. According to Fox Business, which did inflation calculations, in the last 3 years, grocery prices are up 21%. Shelter costs have risen 18.37%. And energy prices, they're up an eye-popping 38.4%. And it seems that inflation is starting to take its toll. And let's just look at the recent retail numbers that were reported. Now, for some context, you've got to remember that the U.S. economy is more than 70% dependent on consumer spending. The U.S. economy is more than 70% dependent on you and I going out and spending money. We are a consumption economy. We are not predominantly a production economy. Now, Mike McHugh wrote a piece on the recent retail numbers, and I thought it was spot on. McHugh said that it's really getting quite difficult for even those with the most optimistic economic outlook to say that where we're headed economically speaking and the current economy is robust. We're getting a lot of evidence that the American consumer is tapped out. Now, if you look at the retail sales numbers, retail sales grew barely at 0.1% in May. If you factor out automobiles and take that from the retail sales calculation, retail sales fell by 0.1%. April retail sales were revised down. This is a trend in the way economic data is reported. There's almost always downward revisions. While the inflation numbers are revised, the unemployment numbers are revised, and the April retail sales number was also revised downward, and April's retail sales declined 0.2%. I expect we'll probably see something similar happen to the May numbers. Now, on an annual basis, retail sales have increased, but by 2.3%. Now, when you look at a year-over-year increase of 2.3%, you might take a look at that stat and say, well, hey, people are still buying more stuff. But what the retail sales data does not do is adjust for price inflation. So are people spending more, or are they buying less but paying more for what they're purchasing? And I would argue that when you dig into these numbers, the latter is the case. McHugh puts it this way: just because dollar widget sales increase, it doesn't mean people bought more widgets. It could mean they bought fewer widgets, but they paid a lot more for each widget they purchased. Falling sales could reflect price drops. Now, that's not the case here, but that is one fundamental flaw in the data. But if we take the official inflation rate of 3.3%, which I would argue is light, and you take a look at the fact that retail sales have increased 2.3%, those numbers alone tell you that Americans are cutting back on discretionary spending. And if you're moving ahead toward retirement, this is obviously a concern. In the information that I'm offering this week, the mid-year market forecast, you'll discover what the inflation forecast is for the rest of the year, as well as the forecast for the U.S. economy, stocks, bonds, and metals. But in addition to the report, I will send you a copy of the best-selling revenue sourcing book that contains a retirement planning strategy for today's economy. And if you haven't taken a look at planning for your retirement in light of current economic conditions and light of current economic trends, let me tell you that in my view, there's a very high probability that if you pursue traditional planning strategies, if you use conventional planning techniques, you may fail in the near future. So I'd invite you to go to requestyourreport.com, get this box of information I'll send you. Again, the website, requestyourreport.com. And there are also additional resources available for free at retirementlifestyleadvocates.com. That's again, retirementlifestyleadvocates.com. I'll be back after these words with my special guest, Dr. Bob McHugh. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me once again on today's program is returning guest, Dr. Robert McHugh. Bob is undoubtedly the hardest working technical analyst in the business. The voluminous amount of information and research he puts out on a daily basis really amazes me. And Bob, it's always a pleasure to have you on the program. I get great feedback, and I'm very excited to hear about your most recent research. So welcome.
Thanks, Dennis. I always like being here with you, and look forward to our conversation today.
Great. Well, if you want to learn more about Bob's work, I encourage you to check out his website at technicalindicatorindex.com. He has some trading programs we'll chat about. Also, his newsletter is must read. So again, I'd encourage you to check that out at technicalindicatorindex.com. So Bob, let's start maybe big picture here. The economic news that's being released is not great. I'm reminded of the Chicago Purchasing Managers Index, where everything seems to be contracting except prices. So it appears that we may be headed for this stagflationary outcome, where we have inflation as far as consumer prices go, but a contracting economy. What's your opinion, big picture?
Well, right now, you're right. That is exactly what it looks like. We're headed for a price inflation on products, services, housing especially, at the same time that there could be a depreciation in the value of some investments like our stock market and bonds, possibly, if they don't go down and interest rates don't go down, then that's going to be a problem. So I would say stagflation is definitely the possibility right now. Now, at some point, I think that once the economy declines sharply, that at that point, then we'll see inflation start to head down and interest rates will fall. But for a period of time here, call it a transitionary period, stagflation is definitely, in my mind, what I'm seeing is going to be the case for a while here.
So, Bob, your work, you're a brilliant technical analyst. Let's just preface this next part of our conversation, if we could, by having you just briefly explain a bit about how you approach your analysis.
Sure. What we do is technical analysis of markets. We consider the fundamental aspects of the economy and so on. We really do take a good hard look at it. We feel that is kind of a fulfillment of the forecasts of technical analysis. The news comes after what's forecast by technical analysis. And what is technical analysis? It's a measure of the psychology of all market participants everywhere that know everything about the markets. And we found that over 100 years here, through the work of Dow and Charles Dow and many others over the course of the last century, that you can predict the stock market's next move and other markets, gold and bonds and everything, based upon patterns that the pricing of these markets produce. And we track the patterns. There's waves, and we're able to take what we look at and say, oh, okay, this market's about to top, or this market's about to decline, and it's going to be a mild one, or it's going to be a severe one. It could be a great boom coming, or it could be a disaster coming. And so we measure this. There's a lot of work involved, and we label it, and we present it in charts. And it basically what we're saying is that the market predicts itself. It communicates where it's headed next. And we take advantage of that information. It's been very accurate for a long time, for decades, and projecting where the next move is, and then the next move you'll see it fulfilled with the you'll see it fulfilled with the news. The news will be the fulfillment of it.
So, Bob, I interview just some market analysts that don't necessarily look at things from a technical perspective, and some of them have the opinion that the Fed will not allow a stock market correction in an election year. What are your charts saying, and would you agree with that statement, or would you disagree with that statement?
Oh, I definitely disagree with that, because we've seen that before, where the market has gone down severely a few months before the presidential election, and that has been the reason for a change in the power in the White House. It's happened many times in the past, so I don't go by that at all. As far as the charts, the technical charts, we are looking for a top in the stock market of pretty significance as soon as these patterns complete. Now, whether they complete now or in a couple of months, or it's hard to say, but there's definitely a major pattern in the major stock indices, all of them, that are saying we're headed for a top, and it's going to be a pretty significant drop afterwards. We've been watching. It's a big pattern. It's been around for almost 30 years, and it's concluding. It's a rising bearish wedge. They're very reliable, and so I'm not so sure that we can say definitively this Fed's going to keep the market up through the election. I don't think so at all.
So, Bob, when you say these patterns are almost complete, and this rising bearish wedge is very reliable, since these patterns tend to repeat, is there an historical time that this rising bearish wedge has appeared, and if so, what was the time frame, and what did the subsequent drop look like?
Well, I have in my newsletter, actually, it's in the current newsletter that I'm putting out this weekend, and I did last weekend too. From 1997 to 2000, the stock market formed a very similar rising bearish wedge pattern to what we're seeing right now. What we're seeing now is even a larger scale than this one. But from 97 to 2000, there was a concluding rising bearish wedge, and it topped in early 2000, and then with a Y2K, and then we had a 3-year recession from 2000 to 2003, and the stock market plunged. It absolutely was a horrendous bear market, 38% crash in the stock market from 2000, and that's when it peaked. That's when the rising wedge ended, and that's what we're seeing now, is this rising bearish wedge. A different one, a bigger one, is finishing now. Whether it's going to finish this month or next month or the month after, I'm not sure, but it's a big one, and so we can expect a similar type of result. And that's just one example. I mean, I've been doing this for years, and this is one of my favorite patterns because it's so reliable, and you see it so often. You'll see it in a short-term scale, you can see it in a long-term scale, or a intermediate-term scale. The one I'm worried about is it's a long-term scale, and that's wrapping up now. The one I just mentioned in 97 and 2000 was I would call it an intermediate size wedge. So yes, it's got definite historical precedence.
So Bob, based on what you just said, is it fair to say that you're expecting that, we could see a decline of 50, 60% in stocks? Am I reading between the lines correctly?
Yes, I do see that. I definitely see that. Yes. Now, not maybe in 1 month, but, over a period of time. Yes. Before it's all over. Yeah.
So, Bob, when you take a look at in a case of a stock market correction, U.S. Treasury bonds have often been a safe haven. You see stock investors that panic; they go to put money in U.S. government bonds. But if you look at what long-term U.S. government bonds have done over the past few years, as the Fed has been increasing interest rates, really maybe the last 2.5 years or so, the performance has been dismal. Do you see U.S. Treasuries being a safe haven if we get this type of a stock market correction, or do you think that maybe we're going to turn the page and see some other asset class maybe outshine U.S. Treasuries in the event we get this big stock market correction?
I would like U.S. Treasuries in an event like that. I would like that a little bit because it's got great historical precedence of being a safe haven. There's a good chance that bond prices will rise, which means interest rates are falling in the event that there's a stock market event, a crash. That's been the historical precedent. That's the reaction. That's what happens. People look at it as a safe haven, and they look at the military might and the economic strength of the U.S. economy. So they say, okay, that's where I'm going to put my money. So I think that's a good option. There are other options like gold, but that's a good one because it's a transaction available, a medium of exchange. So yes, I would say bonds should rally, and that's what the charts are telling me too. As a matter of fact, if you want to look at the technical analysis side of this thing, my charts are saying that we're going to be seeing a bond rally of some significance, and starting, probably contemporaneous or right after we see a stock market drop, and it could be a big one, could be a big rally. So, I show those charts in the newsletter this weekend too. That's where I think they're headed.
So, Bob, in the couple of minutes we have left in this segment, can you talk a little bit about your trading service, your newsletters, and maybe let the listeners know how they could learn more?
Sure. Well, at technicalindicator-index.com is our website, and what we do is we have three services. We have a basic newsletter service that does the technical analysis charts with explanations, analysis, forecasts, says here's where we're headed next in the different markets, gold, silver, bonds, the currencies, and so on, and stocks, of course. And we print that every night it's 5 days a week. And that's our lowest priced offering. And then we have a silver trading membership. It's called silver. It's not that we're trading silver. It's the name of the product. And it's an ETF trading program. And that includes, the price is a little higher, and that includes all our newsletter services, the standard services, plus you can do ETF, get trade ideas from us for that. And then we have our Platinum Premium program, which gives options trades ideas. It's where you can leverage and make significant gains, a little riskier trading options and ETFs, but it gives you another chance to make more money and create an additional income stream. And that includes all the other services we offer, and that's a little bit more expensive. But those are our three products, and they're all available at the website and at the subscribe today button.
Well, the website again is technicalindicator-index.com. I'm chatting today with Dr. Bob McHugh, and I'll continue my conversation with him when RLA Radio returns. Stay with us. I'm Dennis Tubbergen. You are listening to RLA Radio. I'm chatting today with Dr. Bob McHugh. He is a technical analyst, and he works harder than any other analyst that I interview. You can learn more about his work at technicalindicator-index.com. And Bob, prior to the break, you were talking that your analysis is telling you that at the same time we see this stock market correction, that you believe we could see a pretty big rally in U.S. government bonds. And I'm reminded of what's going on geopolitically. You have the BRICS countries that seem to be aggressively pursuing alternatives to U.S. dollars and consequently U.S. treasuries and international trade. To what effect do you think that development might hamper this bond rally, if at all?
Well, there have been other attempts to excuse me. There have been other attempts to do this with the U.S. dollar, to use other currencies and so on. But ultimately, it always boils down to, as things get worse, the migration goes to the U.S. Treasury. It goes to the U.S. dollar. It's the military might. It's the history. It's been a historical safe haven, and I just don't see where that could change a whole lot. during the next international crisis. I would expect just the opposite.
So, Bob, if we could, let's shift gears a minute, because you, in passing in the last segment, mentioned gold. Certainly, when you look at how precious metals have performed in 2024, as we're talking now about halfway through the year, gold and silver have both had pretty big breakouts, and as one might expect, they're pulling back a little bit now. But where do you see metals going from here? What are your charts telling you about both gold and silver?
Oh, I have them going way up. Very powerful bullish market is starting. It's not anywhere near finished. It's just getting started. It's breaking out. The gold is breaking out of a massive 12-year cup and handle pattern that's very reliable. Just broke out of it finally. It's been driving everybody crazy. When's it going to break out? And it just did about a couple months ago. And this upside target is big. It's way up there. So way up there. What is that? Well, I could see it eventually hitting 5,000. To be honest with you, but doing stages and wave patterns, up, down, stair stepping up. Same thing with silver. It's headed up, way up. Maybe it hits 50. It's getting stairs, stair up, stair down, steps, and so on. But these are going to be safe havens. I mean, this almost screaming. It's almost telling us, these charts, why would metals go up so much? Well, yeah, inflation maybe, but I think maybe it may be suggesting an international crisis of some kind, maybe war. My book that I wrote many years ago, 10 years ago, pointed out that when you have economic crises, depressions, economic recessions, you have wars. They're contemporaneous. There's almost always a major war when you have economic crisis, international crisis of economics. So it may be that the silver gold charts are telling us, yes, inflation's here, but it also could be telling us that we're going to see some type of an international crisis, perhaps war, that will make it a safe haven. Like U.S. Treasury bonds, they're going to head up higher. That looks like a safe haven. Something's coming, something that's not great, something that people are going to want to get some security. The stock market's not going to be the answer based on the charts I'm seeing. So there's kind of a picture being drawn by all these charts on these different markets. It's going to be a rotation from stocks into metals and treasuries away from, and that kind of ties in with trouble, so that's what I'm saying.
So, Bob, in the first segment, you mentioned real estate as well. And many times historically, when we've seen a stock market correction, we've also seen real estate decline, almost lockstep with stocks. Do you see it playing out the same way this time?
No, not yet anyway. And I'll tell you why. And you just hit a nerve here. There's an event happening. I just wrote an article. It's at my guest articles free button. Anybody can read it for free on an event that's happening that's a creeping risk to our economy that very little are talking about. And that is the institutional buying of home residences, cash buying. It has gone out of control. It's something like, I don't know what the number is, 35%, 50% of all homes that were sold a year ago were bought by institutions. And these institutions are, REITs, they're private equity firms, they're institutional investors from large corporations and so on, are buying up residential homes and then they're renting them out. And we're becoming a tenant society. And there's a giant buyer. They're outbidding mortgage buyers. They got cash. They got tons of it, and they're buying with cash. They're waiving inspections. They're settling on deals in 10 days, and it's an epidemic, and it's wrong. It's a attempt at monopolizing the real estate markets, driving prices higher. Realtors are helping feed this because they're bird dogging a lot of, not all of them, but a lot of them are bird dogging for these big mega corporations. One name is Blackstone. And it's a whole thing happening, and it's not being attended to. It needs legislation. It needs regulation. And it's actually a violation of the Sherman Antitrust Act for monopoly and restraint of trade. And that is keeping prices higher. In fact, driving real estate prices higher and yet, you see that the how 7-8% mortgage rates. How can housing prices be going up because of this big buyer? And it's not right. It's anti-American. It's a robber baron event. It's not like capitalism. It's not capitalism. See, and that's what the politicians that are conservative have to understand. This is robber baron action. This is gone beyond, capitalism, and it's wrong. It's manipulation, and it has to be stopped. So to answer your question, sorry for the passion, but this is why I don't see real estate going down.
I'm chatting today with Dr. Bob McHugh. His website is technicalindicatorindex.com. And the topic he just spoke about, there's an article available for free under the guest articles section at technicalindicatorindex.com. So, Bob, let me play devil's advocate here if I could. We're seeing huge commercial real estate exposure by banks. We're seeing a lot of vacant office space. Do you see then a disparity between the way residential real estate performs and commercial real estate performs, or do you think all real estate looks bullish here?
That's a good question, and I'm not sure to get what the answer is on that. I know the residential side, I don't see any major drop coming in prices for a while for the reasons I stated. Commercial is interesting. That's different. There may be some decrease in pricing on the commercial side. I know they're in a lot of trouble. There's a lot of vacancies in a lot of the cities. Do they turn those things into homeless shelters? I don't know how that's going to resolve. It's an unprocessed situation. It's a fascinating subject. What's going to happen with all these abandoned commercial properties? The banks are stuck with, will somebody figure out what to do with them? Will the local governments take them over and give them to the homeless, the migrants? Will they be bought out and turned into condos for residential homes? I don't know. It's a very interesting subject. And Dennis, I really am not sure what that's going to do.
So, Bob, let me go back to the precious metals topic, if I could, for just a moment. A couple of questions here. First of all, when you look at gold and silver, you stated that you're very bullish on both of those asset classes. More bullish on one than another?
Probably not. Looking at the charts, they both look real strong. There may be occasions where one moves ahead of the other and then the other catches up, kind of playing tag a little bit. But I do think they'll move pretty much in concert. They both are very bullish patterns. So I'd say I think they both look pretty strong together.
And then we have time for maybe just a couple more questions here. I'm reminded of the Will Rogers quote that said, "I'm going to invest in inflation. It's the only thing going up," which was intended a bit tongue in cheek. However, when you look at food prices, would you be bullish then on if somebody's looking for an alternate asset class? Do you have a thought on other commodities and in particular maybe agricultural commodities?
That's a great question, and possibly yes, because just the fundamentals on agriculture are not strong. Because there's an awful lot of regulation right now, a lot of government intervention that's going against farming. It's putting a pressure on the ability of farmers to produce their crops and then sell them, and it is creating food shortages. I mean, here in Lancaster County, Pennsylvania, they're going after the Amish real hard for no good reason, because they're selling products that are raw, that are they're chemical free, and the Pennsylvania Department of Health in agriculture is just beating them up, and so that's affecting supply. And in Idaho, I think it's Idaho, they're shutting down water to farmers that have been running farms for years. They're now telling them they can't have water, and so they're closing. So there's things happening that are kind of government driven to harm the production of food in this country at various farming areas. So from that perspective, that's not helping lower inflation. And that's just a few examples that I'm aware of for firsthand. But so that might be an idea.
And maybe one more question, Bob. As far as asset classes, sectors, I should say, moving ahead, are there any sectors of the stock market that you think may perform better than others when this crash that you're forecasting hits? Are there any sectors that you're saying, hey, this might be the exception to the rule?
I don't do a lot of separate sector analysis in my work, so it's a little hard for me to identify anything. Let's just say, whenever you have an economic plunge, and it usually results in war. I mean, the defense sector usually does pretty well. There'll be military equipment built and that kind of thing. The Halliburtons and stuff like that might do well, but that, maybe something to look at once it happens. But I don't really have a lot of advice on sector. Like as far as you want to look at technology versus staples, I have technology not looking good either. It's across the board. My rising bearish wedge is in the S&P 500. It's in the technology stocks, NASDAQ 100, and it's showing up in the Dow Industrials. And so I'm not necessarily saying that AI is going to be the answer at all, because that's looking pretty pricey and pretty frothy. And I just wrote another article that's in the guest articles button that people can read for free, pointing out a very interesting chart that says whenever you have a few large companies dominating the stock market, and we do right now, it's just three tech companies are 20% of the market. And if you expand that to say the top 10 tech companies and top 20, we are at the 85th highest percentile of domination by a few corporations driving the stock market than in the history of the stock market. And whenever we've had ultimately high domination by a few stocks, there's ultimately almost always a stock market decline across the board, economic recession, plunge in the stock market shortly thereafter. So that's another warning right now that we have to be careful. And that's why I don't think the AI stocks are going to continue to be the answer if this whole thing goes down. The whole market goes down. I'm not thinking that's a sector that's going to necessarily be saved at this time.
Well, the clock says we're going to have to stop our conversation there. My guest today has been Dr. Bob McHugh. His website is technicalindicatorindex.com. There are some free guest articles there. You can also learn more about his newsletters and trading services. Bob, I always get great feedback when you're on the program. Thank you for joining us today, and I'd love to have you back down the road.
Thanks, Dennis. I always like chatting with you, and I look forward to seeing you, talking to you again.
We will return after these words.
Welcome back to RLA Radio. I'm your host, Dennis Tubbergen, and thanks again to my special guest, Dr. Bob McHugh, for joining me on today's program. In the first segment, I talked about the fact that inflation is really making a lot of existing current retirees think about going back to work. In fact, in the first segment, I mentioned there was a survey conducted by Motley Fool of retirees, and 44% of those surveyed said they were considering going back to the workforce because of inflation. 61% of those surveyed said they were struggling financially. And then we broke down the retail sales numbers to show you that retail sales are up only 2.3% over the past year, but yet the official estimate of inflation, which, as we all know, understates the inflation problem, was up 3.3%. So Americans are spending less. Now, if you go back and take a look at the numbers, let's just look at numbers over the past 3 years. There was a survey conducted that found the average retiree in 2022, this is the last year for which I could find numbers, spent $4,818 a month. In the first segment, I pointed out the average Social Security benefit collected monthly is just a hair over $1,900 a month. So you can see that depending on Social Security to meet your retirement income needs is literally impossible. Now, the same survey found that if you go back 1 year and look at March of 2023 and compare it with March of 2024, the average American household spent $227 more per month for the same items. If you go back 2 years and compare March of 2024 to March of 2022, the average American household spent $784 more per month to purchase the same stuff. And if you go back 3 years and compare March of 2024 with March of 2021, it takes $1,069 per month more to buy the same items and services. So it's really not surprising when you look at those numbers, when you look at the harsh reality of costs, that 44% or nearly 1 in 2 retired Americans are considering returning to the workforce. I would encourage you, if you have not yet done so, to get my June special report, which is the mid-year market forecast. In it, I talk about where inflation likely goes for the rest of the year. I talk about where stocks, bonds, and gold may go for the rest of the year. And even as important, in the package of information that I will send you, I am going to include a copy of the best-selling revenue sourcing book. The revenue sourcing book contains a planning strategy for the current economy. So certainly, if you have done what you would consider to be traditional planning, conventional planning, planning the same way that your parents and maybe grandparents did, this is certainly a perspective that I think is really important for you to have. Now, when you take a look at what's happened out there in the broad economy, if you go back to 2020, at the time of COVID, there was a lot of stimulus money distributed. Now, at that time, Americans who received the stimulus money, the data shows they used this extra money to pay down their credit cards and to add to their savings. Now, how was this stimulus funded? Well, currency was created. So ironically, the stimulus created inflation indirectly because, keep in mind, the Fed injected via quantitative easing, via currency creation, trillions of dollars into the economy. That's where inflation comes from. There's really no disputing that, despite the fact that there are many analysts that have tried to dance around the issue. It is as simple as that. Well, then we started to see savings diminish as inflation kicked in as a result of this currency creation. The San Francisco Federal Reserve, in fact, estimated the total aggregate savings of Americans stood at $2.1 trillion in August of 2021. So a lot of this stimulus money was used to pay down debt, and it was put in the bank in a savings account. But by June of 2023, that aggregate savings fell, according to the San Francisco Fed, from 2.1 trillion to 190 billion. That means that Americans went through $1.9 trillion in savings in just 2 years. And then, according to the numbers, they turned to plastic. I've reported on past programs here that we've seen Americans now accumulate credit card debt of about $1.4 trillion. And now all of a sudden we're seeing credit card debt accumulation slow, indicating that perhaps Americans have reached their credit limit. This is not good news for the consumer spending dependent U.S. economy. We'll have to wait and see how this plays out. But I believe that we are in a recession presently. Certainly when you take out deficit spending by the government, I believe that we are. I'm approaching the end of the show here today, so let me again remind you, go to requestyourreport.com to get all the free information. Again, that is requestyourreport.com. I'll be back next week with another program.